Investing is often seen as a numbers game. We analyze charts, study financial statements, and try to predict market movements. However, there's a crucial element that significantly influences our investment outcomes: our psychology. The way we perceive risk, handle fear, and manage greed plays a pivotal role in our investment decisions. Understanding and mastering our emotions is as vital as understanding financial ratios and market trends. Psychological pitfalls can derail even the most well-thought-out investment plans. Emotions like fear and greed can cloud judgment and lead to impulsive actions. These actions often work against our best interests. We might buy high out of fear of missing out or sell low driven by panic. This emotional roller coaster can severely impact our portfolio returns over time. Recognizing the power of emotions is the first step towards making sound investment decisions. We need to acknowledge that we are not always rational actors in the market. By understanding our behavioral biases, we can start to mitigate their negative effects. This awareness allows us to make more rational, disciplined decisions aligned with our long-term financial goals. One of the most prevalent psychological pitfalls in investing is the fear of missing out. When we see an asset class or a particular stock soaring, our instinct is to jump on board, afraid of being left behind. This impulsive behavior often leads to buying at inflated prices, only to see the investment decline later. Panic selling is another common trap. When markets plummet, fear takes over and we tend to sell our holdings to avoid further losses. This reaction is often driven by herd mentality, as we see others selling and follow suit. However, panic selling usually leads to realizing losses at the worst possible time, locking in losses that could have been recovered over time. Overconfidence is a more insidious psychological bias that can lead to excessive risk-taking. After a few successful trades or a period of market euphoria, we might start believing we have an exceptional ability to time the market or pick winning stocks consistently. This overconfidence can lead to concentrated bets and a lack of diversification, exposing our portfolio to significant downside risk. The first step to managing emotions in investing is cultivating self-awareness. We need to recognize our emotional triggers, those market events or news headlines that evoke strong emotional responses. Once we identify these triggers, we can develop strategies to mitigate their impact on our decision-making. A well-defined investment plan is crucial for navigating the emotional ups and downs of the market. This plan should outline our financial goals, risk tolerance, and investment horizon. Having a clear roadmap helps us stay focused on the long term and avoid making impulsive decisions based on short-term market fluctuations. Dollar-cost averaging is a powerful strategy that takes advantage of market volatility while promoting disciplined investing. Instead of trying to time the market, we invest a fixed amount at regular intervals, regardless of the market price. This approach allows us to buy more shares when prices are low and fewer shares when prices are high, averaging out our purchase price over time. Diversification is another essential element of a resilient investment strategy. By spreading our investments across different asset classes, sectors, and geographies, we reduce the impact of any single investment on our overall portfolio. This diversification helps mitigate risk and smooth out returns over time. Investing is a marathon, not a sprint. Patience is crucial for long-term success in the market. It's easy to get caught up in the daily noise of the market, but we need to remember that short-term fluctuations are inevitable. Trying to time the market consistently is futile and often detrimental to our returns. Instead of fearing losses, we should view them as learning opportunities. Every investment decision, whether successful or not, provides valuable lessons about ourselves and the market. By analyzing our past mistakes, we can refine our investment process and make better decisions in the future. Understanding market psychology is as important as understanding financial statements. The market is driven by emotions, and recognizing these emotional undercurrents can give us an edge. By combining our knowledge of finance with an understanding of human behavior, we can make more informed and rational investment decisions. Remember, investing is not just about picking stocks, it's about managing risk, controlling emotions, and staying committed to our long-term financial goals.